Let's also connect then with Pankaj Pandey, who is joining in on the show, head research at ICICIdirect.com. Pankaj, good to have you on board. Let's begin then by talking a little bit about what's happening within individual sectors and in particular real estate. We've been talking about the relief coming in with the amendments in the finance bill. How are you looking at this news for the sector?
So hi, good morning. Thanks for having me. See, real estate as a sector looks quite attractive to us. And after a long period of time, we are seeing improvement in the overall numbers, broader numbers for sector. And our sense is that while this amendment is definitely going to help, but I think the prospects of rate cut have also sort of improved, especially in the US. And I think some spillover can happen in the domestic market also, given the fact that our inflation is also on a lower side. So from that perspective, real estate looks good to us because what will happen is that at this point in time, the premium segment of the market was doing well, and our sense is that with this kind of anticipation of further rate cuts and amendments like these, the growth will sort of broaden up. Overall sense is that the double-digit kind of a pre-sales growth has been largely maintained by most of the players. But valuation also has sort of inched up. So what we are sort of liking is more of home building products like say Somani Ceramics, where gas prices are stable, margins are expected to sort of perk up, and volume growth, especially in the second half, is expected to be good. The same is the case with green ply. Overall sense is that in the second half, things are going to be a lot more better. So these two companies is what we are liking within the results which have come out specifically.
Right, interesting. Pankaj, what else is your, current overweight bias, if at all, in the market? Anything that you recommend buying if the market were to give further dips from here? Although this morning it seems like there's a lot more stability.
So I think it's very stock specific. Just to sort of highlight, for example, we have been liking the graphite electrode as a space. So graphite numbers came out to be good. The one, I think on the margin front, there was a good amount of turnaround because from -1% kind of a margin, we have moved to somewhere about 11% kind of a margin. Capacity utilizations have inched up. And we feel that there is a turnaround which is coming in this sector, and both graphite and HEG look attractive to us. Infra as a space, our sense is that that should keep doing well because overall in the second half, we would expect announcement across, be it in road or other segments. So NCC remains our top pick. I think the numbers were also sort of quite okay. Company has maintained their 15% growth guidance margins growth guidance.
Pankaj, let's understand what your outlook is then when it comes to some of these pharma companies in particular. How have you read into Lupin's numbers? It's been pretty much above what the street was penciling in on all fronts.
Absolutely. I think Lupin numbers were quite good. We've seen about 300 bips kind of a gross margin expansion, and company has been maintaining margins to sort of remain about 20% kind of a level. The domestic growth or the US growth has been pretty good because we have seen about 3 product launches in both the segments. So pharma in general, if you look at US as a segment, has done very well for most of the companies, be it Cipla, be it Sun Pharma, and domestic growth has been quite steady. So I think pharma is one sector which is witnessing overall decent performance in crucial geographies. And while we'll have to work out the numbers for Lupin, but in general, we have seen pharma sector sort of coming out with a good set of numbers.
What is it that you're making of the consumption trends so far, Pankaj? And I'm talking about companies like Bata, for instance, wherein there's been a huge EBITDA hit and quite a disappointing earnings, in fact.
So on the consumption side, Bata, we don't have a coverage, but what we are liking is autos in general because auto, our sense is that two-wheeler as a pack is going to sort of deliver a double-digit kind of a growth. And I think export leg is also sort of reviving for a lot of most of the companies. In addition to that, I think while some companies say, for example, Tata Motors might not do much in the next 2 quarters, given the fact that there is the impact of aluminum supplies from one of their suppliers. that could get impacted. But in general, auto looks good to us from the perspective that overall you see a good amount of premiumization which is sort of going on. So while the volume growth could still be in single digits, overall the turnover growth could be a lot more higher. Top pick here is M&M. I think this is one company which has seen quarter-on-quarter margin expansion in both the farm equipment and also on the UV side of the portfolio. Plus, the order book is quite decent. So auto, I think within the, if somebody has to sort of play the consumption theme, I think is the attractive bit. And besides that, I think hospitals is something which we are liking.
Meantime, Pankaj, let's get in your thoughts on some of the result reactions. How have you read into the standalone quarterly numbers for PB Fintech, which has been pretty strong, and completely different aside of that is Cummins as well, where the profits grew about 33%.
So don't cover both the stocks, but if I have to sort of talk on, say, for example, Shree Cement, the numbers are definitely below expectation. While we might see volume growth going forward because they're expanding their capacities by 15 million tons, but I think cement is seeing a lower realization, largely more in southern markets. But in general, you see a softness in the prices, and probably that is going to be there for another quarter. I think second half is where our sense is that things will start looking a lot more better because that is when the execution on the other or the user industries is expected to sort of pick up. But cement is another space where our sense is that we haven't seen much of a price reaction, but post this monsoon season, things should start looking a lot more better, both in terms of pricing also, and also from the perspective that we are going to see a decent amount of cost savings.
Pankaj, nothing is wrong with banks, but looks like everybody's selling banks. Why is that? Everybody wants to view, I mean, when I say everybody, the general consensus view is that banks is the best place to be in. Yet, the fact that these stocks are not going higher is because somebody's selling it. Why is that?
So I think, Nikunj, if you sort of look at FI selling typically happens in two sectors, which is IT and banks. And last 2 days, we have seen a decent number of FPI as sort of selling, and bank is obviously taking a pressure. Then the other perspective on the banks is that in general, if you look at in this particular quarter, we have seen on the unsecured side, there has been an uptick in the asset quality, downtick in the asset quality, largely because personal loans below, say, 50,000 has seen some bit of a deterioration in asset quality. Same is the case with even credit cards as well. And I think what you're clearly seeing is that the deposit growth is still sort of lagging while banks are able to maintain their margins. But somewhere down the line, something or the other needs to sort of break. Either the deposit, for raising deposit, they'll have to sort of raise rates, or which will compromise or which will lead to some lower margins. So which is where I think, despite attractive valuations, some of these near-term concerns are bothering the entire sector as of now.
Pankaj, there was a bit of a relief rally in some of the real estate stocks, and now that the amendment in the finance bill has already happened, how constructive should markets view this?
So I think, like I highlighted, definitely it's a positive for the markets. I think another positive, which I also highlighted, is that the prospect of rate cut has sort of improved. That should broaden up the growth for the sector. And we are seeing a decent amount of commentary from most of the players. Again, our liking is typically with companies like, say, Brigade and say Mahindra Life. But in general, the pre-sales have been pretty good, expected to remain in double digits. So from that perspective, I think real estate as a sector is looking attractive to us. The only challenge is that the valuations have sort of gone up. One needs to be very selective in real estate, but any kind of a price correction, I think, should be a good opportunity to buy.
Your thoughts, Pankaj, on the latest note coming out from Jefferies, what it is going to be with respect to the change of guard and the target of 1,000?
So we also have a target price of 1,000 on SBI, largely because I think the growth is expected to be sustained in the range of 13 to 15%. ROA is at 1%. So we valued this at 1.5 time adjusted book basis on FY26, and then you have about 200 coming from the subsidiaries. I think what they've done is that in the last few quarters, they've maintained both performance in their core segment, along with maintaining the asset quality. And I think and management is also confident in terms of growth margins being sustained. So I think near-term weakness we have seen, but we feel that SBI looks attractive to us. Again, I reiterate with a target price of 1,000.
SBI has reported profits which are higher than Reliance now. And guys, you have to understand it's a bank. Reliance is a conglomerate. You can't look at it that, okay, SBI profits are higher than Reliance. Why? Because there are write-offs, write-backs, base effect, extraordinary income cycle. Those are also at play. Having said that, I think SBI has been like this real, in terms of growth, in terms of valuations, in terms of market share, in terms of size, in terms of scale, in terms of leadership, they've demonstrated it all. The ROA is 1% plus. I remember we had coined this phase with Dinesh Kumar Khara that who says elephants cannot dance, and SBI is that elephant which is forget dancing, it is doing salsa now. It's just been such an incredible run up for SBI that it's got India's largest credit card business. It's got India's largest life insurance business. It got India's largest AMC. And in terms of scale and size, take HDFC Bank and HDFC Limited merger out, it actually has 20% plus market share. Pankaj Pandey, you've just shared your thoughts on SBI, but I've added some more superlatives. Now let's discuss it again. Why is this stock with so many advantages is trading at a price to book of less than 2?
So I think typically when you look at PSUs, see structurally, you don't believe that their ROAs can inch up to say 2%. So 1.5% is where the maximum range lies historically, because you need to see the composition of book, and which is where I think private banks do a lot more better in terms of ROAs being higher. And which is why, I mean, we look at most of the PSU banks, I mean, not only SBI, even SBI, even Bob also, while their ROAs are at 1.2, but valuations are at about 1 or 1.1. I think it is more to do with structurally, we have not seen them delivering more than a 1.5% kind of ROA. So, which is where I think things or the valuations really do not go up. I think something probably they need to venture into high margin categories for the ROAs to sort of actually improve, and then that is where the possibility can happen in terms of multiples inching up further. As of now, we don't see with the numbers for the next 2 years.
Okay. Pankaj Pandey, it's a great point, isn't it? Right? I mean, what we saw on Monday was almost like scary. What were the headlines? Stampede. Worst fall in last 7 years. Reminiscence of 2018. Worst day after COVID. And 3 days, and today we are talking about a breakout.
Nikunj, I think, global volatility is here to stay for some period of time, I think, till US elections, because we still don't know what kind of tariff hike US can do. And there is also an element of currency depreciation, which is also sort of coming as a renewed fear. And that can sort of keep the volatility at higher levels. And while the near-term concerns because of this has sort of subsided, but I think volatility is going to be there. What we are largely focusing is more on the domestic-oriented sectors, because it could have complications for a lot of export-oriented sectors, some in positive way, some in negative way. So I think we are still not sure. It's very difficult to bake in a scenario in terms of how things will pan out globally.
All right. Pankaj, good to have you on board. Thanks so much for joining in.
Thank you so much.